Hello, this is Chuck Cardinal, co-founder of FastGraphs, the fundamentals analyzer software tool. With this video, I'm going to look at 10 more fairly valued or even attractively valued dividend growth stocks, as I have in my previous two submissions. The first research candidate I'm going to review is the life and health insurer Principal Financial Group, and a couple of interesting things about their historical record. Started out here with a plotting of the company's earnings per share, and I want you to notice they had good growth coming into the Great Recession since 2002. Then they had two very significant down years during the recession. And then they had some flat earnings growth through 2012, followed by some decent growth since. If I put monthly closing stock prices on the graph, you see a couple of interesting relationships here. A tight fit of price and earnings coming into the recession, this huge drop in value, something you ought to be thinking about when you evaluate this company. But then coming from this low valuation, the PE got down to only 2, by the way, by February of 09, you had this nice growth going forward. When I add the company's dividend record, you see that they only started paying a dividend since 02. The area below this white line is the payout ratio. They cut the dividend by 50% during the Great Recession, but they've increased it significantly ever since. Another point that I want to put out here is since the Great Recession, this company has really traded at a relatively low 11 or 12 PE ratio, 11.9 to 12 PE ratio for most of the time. So the orange line isn't quite as important here as the blue line is. The company's historical performance has been decent. You'll notice the dividend growth rate has averaged over 7%, even though they cut it in 2008, as I talked about before. They ended up generating significantly more dividend income than the S&P 500. Their capital appreciation was pretty much a dead heat, slightly outperformed the S&P during this time frame, and their total annual rate of return was a little better, almost a percentage faster growth than the S&P over this time frame, again attributed significantly to the dividend income. As far as looking to the future here, I'm going to use the normal PE multiple, or the multiple we saw with the blue line on the previous graph. And you can see that rate of return potential for this year looks very attractive at over 25%. We still have almost a 16.5% expected rate of return going out to 2019. And if I went all the way out to 2012, it's still 14%. So the real advantage here is we've got a very nice valuation, slightly below their historical norms, a 3.4% dividend yield. It's a BBB plus company and only has 19% debt to capital. So this is one you might want to take a look at if you're looking for a decent current yield with good long-term capital gains potential or high total return going forward. My next research candidate is Omnicom Group, one of the largest advertising agencies in the world. And there's a couple of interesting things about this graph that really are striking to me. We see this very high valuation. We had PEs that were incredible in the 39, 35 range, even as high as 50 in December of 1999, the peak of irrational exuberance. But even with this high starting valuation, notice that this company's grown earnings at an average rate of 9.1% a year. So if I compare this to the S&P 500, we can see that they did produce more dividend income, and even in spite of the high starting valuation, they moderately outperformed S&P on capital gain, and their total return was approximately 1 percentage point higher. Now, what's interesting about this is that with this period of high valuation, even though the company grew earnings quite nicely here, you really did have very poor performance for this long extended period of time from January of 2000 through March of 2009. You would have actually lost money owning this stock. Of course, in contrast, had you bought it when the valuation was low here at a PE of under 8 and held it to today, even though the value has corrected significantly, you end up with a 15% rate of return. So this is another example where valuation matters, and it matters a lot. I also want you to look at their payout ratio real quickly. You can see this area below the white line is the portion of earnings they pay out in dividends, or the dividend payout ratio. It was relatively low in these years, but it has expanded or increased in more recent years. You look down here at the dividend payout ratio column, you can see that it was paying out about somewhere in the 20%-ish area of earnings. Now they're paying out 45 to 50% of their earnings more recently. So this is a decent investment looking forward based on valuation. It's forecast to grow at about 7%. Using the normal multiple of 16.9, which is a little higher in this example, we could see some really exceptional rates of return for the next 2 or 3 years. This year especially, the potential return is pretty exciting. And then I also want to very quickly look at their analyst scorecard, because if you look at how they've performed relative to analyst forecasts going forward on both a 1 and 2 year basis, they've met analyst forecasts quite nicely. So, there's some credibility that these estimates may be decent, and this could be a real attractive candidate going forward. Next, I want to take a look at the drug retailer CVS Health Corporation. And of course, we had the big Amazon scare going on, and a lot of people attribute that significant drop in value from its peak in July of 2015 to its lows currently as of April 11th. But I also think you can attribute that to a flat earnings growth. They only had 1% earnings growth in 2017, and there's still some fears going out there about what Amazon. But again, you see another case where you had a very low dividend payout ratio that's expanded more in recent years. It was paying out 10 to 12% of its earnings in these early years here, 01, 02, 03, or 04. It's now paying out about a third of its earnings going forward. As a result, they have underperformed the S&P on a total income basis. They've moderately outproduced it on a capital appreciation basis, and I'd say it's almost a dead heat with the S&P over the long-term growth rate. However, if I shorten this time frame to the last 9 years, or since 2012, even with this extremely low valuation, we see that the company has almost performed in line with the S&P on a dividend basis, but it significantly underperformed the S&P in more recent years. But I would attribute that more than anything to the low valuation. If you recall from the written part of this article, the S&P 500 is currently overvalued, trading at almost a 20 PE, while this stock is only currently trading at a 10 PE. I think it's a great opportunity going forward here. Going out for the next couple of years, analyst estimates are for some pretty decent growth, around 8 or 9%. They expect 5.75% growth for 2018, followed by 11%. So if we just go out to these next 2 years, we could see 36% annualized rates of return if it went back to a reasonable PE of 15. If it went to its normal PE of 16, then we would have almost 100% growth this year, followed by still averaging over 40% annualized return for the next couple of years. Once again, we see an excellent analyst scorecard where the company has met or exceeded analyst estimates virtually 100% of the time. My next research candidate is National Fuel Gas Company, a gas utility. A couple of things about this stock. Like most utilities, it's very low growth. It does have a moderate amount of cyclicality. You can see the earnings line has, a lot of peaks and little peaks and valleys here. However, the thing that strikes me most, even with this low growth, there's a lot of volatility in this stock. Look at these price swings that you see on this stock from 2011 to 2012. It's currently reasonably valued, offers a 3.2% dividend yield. It's only BBB rated with a 52% debt to capital, but it does look like a reasonable yield investment going forward. Not really great on rates of return, but it does offer a decent amount of income. I want you to also notice, though, that the dividend income has grown at about 3.5% a year. Consequently, it's produced approximately twice as much dividend income as the S&P since September of 2001. Moderately underperformed it on capital appreciation, but it has outperformed it on a total return, most of it attributed to the dividend income. So even though you've got all this price volatility here, you see a very consistent record of dividend growth, but this will probably be my least favorite of the candidates I'm showing in this particular article. My next candidate is the premier automotive retailer Penske Automotive Group. A couple of interesting things about this graph. They did cut their dividend as they came out of the recession, and they didn't start paying a dividend again until 2011. But the company has actually had pretty decent performance, and you see a very highly correlated price and earnings relationship. The fit was extremely tight over this period of time. Now we've got into some volatility as the markets have kind of gotten crazy here. Again, you've got Tesla and things like that, I'm sure, affecting this company. Its long-term performance has been exceptional. It's generated significantly more dividend income than the S&P. It's almost doubled it on a capital appreciation basis and almost doubled it on a total return basis over this time frame. So this is actually an intriguing company to look at. Valuation is certainly low at less than 10 times earnings with a 3.2% dividend yield. The company only has 25% debt. And if you're not really familiar with this company, let me go take you into the company's website from Fast Graphs here and give you some orientation into who the company is. One thing I do like about the company, as an auto retailer, it really has some premier brands mixed in with some what I'll call regular brands. You've got BMW, Bentley, Audi, Cadillac, but then of course you have Chevrolet, etc., and Ford. So it's a very interesting automotive dealership conglomerate. My next research candidate is the household appliance manufacturer Whirlpool Corporation. I almost see this as a tale of two different companies. First of all, we've got a very consistent dividend record here. The company has frozen their dividend on several occasions, but they've consistently paid a dividend. The dividend growth rate has averaged over 7.8%. They've therefore produced more dividend income than the S&P, and they've outperformed it on a capital gain over this long time frame and on a total return basis as well. However, what's really striking about this company as we look to more recent years, I'm going to shorten this graph to 7 years, you can see that their growth rate has accelerated to 10%. And their dividend growth rate has accelerated to 15 to 16%. So this company is actually changing its stripes. It's got very decent growth potential going forward. So I go down to the analyst forecast. You can see growth is expected to be over 11% for this year, over 13% next year, and another 12%. And this simply means there's no data or no analyst forecasting anything or forecasting dividends, although I do have a few analysts giving some earnings forecasts. But if you look at the rate of return potential at a 15 PE ratio, it's over 30% out to 2020. It would be over 40% out to 2019 and over 18%. One of the reasons I do this, by the way, I'm a firm believer in running the numbers out to their logical conclusion. So with this forecasting calculator, I never make an investment and just hope it goes up. I always have a specific rate of return in mind. I think this is an excellent candidate going forward. It has great valuation, it's got iconic brands, and it's definitely undervalued at these levels in my opinion. My next research candidate is the healthcare distributor Cardinal Health, and there's so many interesting stories about this stock when you look at it. You see very low dividend payout ratio, although you see consistent dividend growth historically, and then the payout ratio has expanded quite nicely in recent years. But look at these valuation metrics here. You see this extreme valuation back in 2001, and that valuation stayed even though earnings were erratic. It did have a couple of down years during the recession, and coming out of the Great Recession, it's been growing earnings rather nicely. If I shorten this here, you can see they've been growing earnings about 11%. This is a very attractively valued stock. Forecasts for the next couple of years are 13% growth in 2019. I might point out this has a June fiscal year end, so growth for fiscal year 2018 is expected to be flat, which is partially explains the down year. But then there are 19 analysts forecasting double-digit growth, 13.68% for fiscal year 2019, followed by about 8.5 to 9% growth for fiscal year 2020 ending in June. So you've got some really nice rate of return potential here. The dividend yield's of 2.9. It's 11.8 PE ratio. Company does have some debt, BBB plus rated, but I think this is really another case of valuation here trumps everything else on this particular candidate. My next research candidate is the toy maker Hasbro. I'm going to shorten this graph to 15 years to kind of get past the last recession. It's had a decent record of earnings growth. It certainly has had a decent record of dividend growth. You can see they did freeze the dividend during the Great Recession, but the average growth rate of the dividend has been over 16% a year. They've produced, as a result, significantly more dividend income during this time frame. I'm looking at December of 2005 to yesterday's close. They've also dramatically outperformed the S&P 500 on a total return or a capital gain or capital appreciation potential, and they've again almost doubled on a total return, 14% versus 7.5% for the S&P 500. Of all the candidates I'm showing, though, the valuation of this one is not as good as I've seen with other candidates, and forecast growth going forward is considered to be rather anemic also. But nevertheless, it's a decent valuation with moderate growth going forward. This might be one I'd be a little cautious with, but I did want to bring it to your attention because this was a very popular stock just as late as June of last year and even May of last year. You had these very high valuations, and we have seen a moderate. My next candidate is Ryder Systems, the trucking company, and there's all kind of talk about Tesla coming out with electric trucks, etc. But this company is really on the cutting edge of the trucking industry. They have a great dividend record, not so hot operating history. The company does have some cyclicality. You can see they really earnings fell by over 60% during the Great Recession. That the stock is reasonably valued at a PE ratio of 14.8 with a 2.9% dividend yield. Again, it's BBB plus with some debt. Earnings forecast going forward is for over 20% growth for fiscal year 2018, followed by almost 18% growth in 2019. So this offers some really interesting return potential. If I even use a more moderate PE ratio, we still have double-digit 20% plus rate return expectations for the next couple of years. The only thing I will point out about this particular company, the analyst scorecard has not been as pristine as we've seen with some other examples, especially in the last couple of years. So we might want to question what the forecasts are, but those earnings misses are also related to the drops in earnings we saw for fiscal 2016 and 27. And then last but not least, I bring you Walgreens Boots Alliance. There's a couple of things about this that really intrigue me. First of all, it's very similar to CVS, obviously, and roughly the same business, but there are differences. But what I really want you to see here, I'm going to take the normal PE off of the graph. This is a company that was chronically overvalued for many years, and I've talked about this often. There's an inevitable reversion to the mean when you see this, but in this case, we went from November of 2000 all the way through September of 2008 before the PE ratio of this stock, which was as high as 58 back in 2000, reverted to the mean or the rational PE of 15, as you see here. But of course, since that time, we've had some more rational pricing. We did get overvaluation in 2015, and the stock is now undervalued with a PE of 11.4, dividend yield of 2.5%, BBB rated with only 28% debt to capital. But I really think this point about valuation here, this idea that there's an inevitable reversion to the mean, I think is profound. But as I pointed out in the article, it's not always very predictable what the timing will be, but it's almost inevitable. So when you see high valuations like this, I hope you understand the risk you're taking, because if I scroll back in time here and look at the company's operating performance during these high valuations, the company was performing beautifully. Dividends were growing, payout ratio was relatively low, earnings were growing at over 15% a year. But these high valuations really created an environment where performance just simply couldn't do anything. The headwinds of overvaluation just simply took all the performance out of it. Nevertheless, it's actually got some acceleration in growth. It's a good retailer with a decent yield and a very low valuation. So it's one I think you might want to look at along with CVS, and you can pick between the two. I find them virtually interchangeable from a standpoint of the businesses they're in. I do want to point out that I've gone very quickly since I'm covering so many candidates in all of these videos, but I hope you get a nice perspective of some of the valuations that are available in today's marketplace on some dividend growth stocks. It's been Chuck Cardinal saying thanks for listening.